Good morning, everyone. You're very welcome to this morning's information webinar about our new short course that we are excited to be launching in collaboration with Gillen Markets called Principles of Sound Investing. My name is Eva Lavin and my role in LIA is Head of Education. And I'm delighted to be joined here today by Rory Gillen, founder of Gillen Markets. Rory is the author and lecturer of this course and brings a wealth of knowledge and experience, having worked in the financial services industry for over 35 years. He's a qualified chartered accountant and has previously worked in NCB Stockbrokers, Zurich, and co-founded Merian Capital in 1999. He is also an author of Three Steps to Investment Success, as well as a regular commentator in the media on investment related topics. So we're delighted to have worked with Rory on this course. So just in terms of what we're going to be covering in this morning's webinar, and Rory, I might get you just to move to the next slide there if you don't mind. So in terms of today, we'll be giving you a high-level overview of the course delivery and the logistics. And then Rory's going to take you through an overview of the course itself, the modules, who the course is tailored for, and what you can expect to take away from the course. And then at the end, we will have a Q&A session for any of your questions. In terms of just the course delivery and the logistics, so we might just move, sorry, Roy, just the next slide there. The course is available on demand, so meaning that the lectures are pre-recorded, so they can be completed in your own time and at your own pace. And then at the end of each module, there is a short quiz that will test your knowledge. There's 8 modules in total, and those that complete the course will get 3 hours CPD if you have an annual CPD requirement. You will also get a certificate of completion from LIA, and then you can also register with Gillen Markets to obtain a series of 6 complimentary investment-related booklets. The course itself then is €300 for LIA members and €350 for non-LIA members. Registration is open at the moment, so you can register for the course. And as I said, it is available on demand, so it is open-ended, so there is no, I suppose, cut-off date in terms of the registration period either. So as I mentioned, if you do have any questions during this webinar for myself or for Rory, please use the Q&A box at the bottom of your screen and then we'll answer those questions at the end. So I'm now going to hand you over to Rory. Thanks, Rory.
Great, thanks, Eva, and thanks to the LIA for inviting us to do this collaboration, which we haven't done before, and I think it's very interesting. Look, Eva's given my background, so I'll just flick through that. And Gillen Markets was started in 2005, really as a training course, and it went on from there. And we have a couple of other strings to our bow, but essentially we're an investment intermediary with some educational add-ons and an investment newsletter. So I've been delivering myself investment training courses since 2005. I started really as a pastime. I have a good interest in the training side of things. What I've always been interested in is delivering a practical course rather than a theoretically driven course. We all know if we go to university, our official courses that you'll hear about, the capital asset pricing model, or CAPM, as it's referred to, you know, as the Bible in terms of value an asset. Unfortunately, it's just plain wrong. And I would assume in sort of 15 or 20 years that it won't be part of curriculum anymore. Hopefully not, anyway. You know, valuing assets is not an easy discipline, but the good news for most investors or advisors is that you don't need to be an expert in valuing assets to be able to be a practitioner in the industry. There's a lot of other good ways or easy ways to go about the role. You know, what people do need, in my experience, is an understanding of why stock markets and property prices rise over time. And you know, I've often taken in interns to our business during the summer to give them a little bit of training. And I always ask them the simple question: why do markets rise over time? And even if they've done a 4-year financial course in university, they struggle to answer the question, which is a very simple one. This course will answer it for you. And what are the fundamental drivers of the returns, whether it's property or whether it's the stock market? I would make very little distinction between property and the stock markets, and I'll probably touch on that later. And of course, how do you capture those returns? And how do you mitigate against the risks? As in, how do you lower the risks of investing in risk assets? And you've got to understand volatility in markets, and you've got to understand that it's not actually the risk you're trying to avoid. Um, and that does take a little bit of understanding. Look, I did a book in 2012. Not that I had a lot to add to the investment scene out there, but it was more marketing on my part because I had a training course and I had a website and newsletter, and I was trying to market it. So I did write a book at that time. But I came up with what I thought were the three key areas or key issues for in terms of making a success out of investing. And one is to understand the power of compounding and have the patience to let it work its magic, because it does that over time. Even a 3 to 4 year view is not enough. You have to have a long-term view. And then you have to adopt an approach that suits you. And I call that an easy to follow approach. And what works for one person is different than what works for another person. And it's good for people who are in the industry as advisors to understand that, and that there's easy ways to communicate how to succeed in investing. And then you've got to understand stock market volatility. Why is it so volatile? And then you've got to make sure that your plan doesn't volatility doesn't knock you off course. And then you really have the 3 steps to, as I call it, investment success. The overview of the course is, of course, you've got to understand financial planning and compounding, why stock markets produce better returns than, say, bank deposits. That's the point of the whole thing. There's nothing wrong with bank deposits as long as they give you a positive return. And thankfully, we're back in an era where you can at least get some sort of return. Obviously, the banks aren't giving much a return on bank deposits, but that the investment platforms in Ireland do actually have money market funds on them. So you can actually get close to the ECB rate, even if the banks don't deliver that on bank deposits. Then you've got to be able to define the risks. And if you're dealing with your clients or retail investors, I think it's very important to be able to articulate what actually risk is. And of course, there's different ways of gaining exposure to the markets, not just one way. And then you should be able to define the long term. What is the long term? And speculating versus investing, because the stock markets accommodate the speculative nature or the speculative juices in human nature. A lot of people do like to speculate, but it's not good for your investment health. So they're two very different disciplines, but they both coexist in the markets, and one has to have a good understanding of the distance between the two, the difference between the two. Terminology, it's a little bit more. Stock markets have a bit more terminology in them than the property markets, and that just needs to be demystified. The impact of interest rates on asset values. It's not a complex topic, but I think the trick is to really make it easy to understand, because it is very important. Interest rates do have an impact on how you value an asset, certainly over the short to medium term. On a longer term scheme of things, it's more about earnings growth and rental incomes and things like that drive the asset value. But in the short and medium term, interest rates can have a big impact. Easy to follow approaches are very important. I think if you are an advisor or you work in a life and pensions broker and you're trying to communicate to clients what approach you're following for them to make it easy, and mitigating the risks, obviously. So these are all different modules in the course, and I think they're delivered in reasonably easy to digest format, about 20-25 minutes is each one. And as Eva said, you can do it on your mobile phone, you can do it on your laptop, you can do it on your PC, so you can do it from any environment. So it's user friendly like that. And there's the modules in terms of module 1, 2, 3, 4, a little bit more defined there. Financial planning and compounding, stock markets produce better returns. You know, really to communicate to clients, you really have to have a good understanding why that is. And I think that builds trust. Um, and I think we've covered that. So there's 8 modules in it, and the 9th module in the course is just a good recap for you at the end of it. And of course, as Eva said, there's a Q&A session at the end of each module to make sure that you're learning as you go. As you know, learning is about doing, and you have to have a little exam or a little questionnaire at the end to make sure you absorb the information. So who's the course for? Well, I believe the life and pension brokers around the country. Anyone who's working in a life and pension broker, whether it's on the advisory side or even the administration side, I think it's a good basic course to be doing. Anyone starting out in financial services, pensioneer trustees, I think important for them to have a reasonable understanding. Obviously, retail investors, it's also aimed at them. We do, in Gillen Markets, I do a couple of one-day, in-person one-day investment training courses during the year. And here's a testimonial we got. I haven't asked for a testimonial for about 10 years, but I did ask one on the last seminar we did, which I think is worth reading because it's a very powerful one. And let me just read it. And this isn't backslapping or anything. It's just, here's an ordinary business owner who did the course, and really it just was beyond his expectations. So he says he had the privilege of attending. We do evening workshops as well. They're kind of 1-hour events, but this is the main one-day course, which he felt he grasped a lot of the concepts before that, but he'd never seen the whole framework put together in the way it was. That it really got him from the beginning to end. And I think that kind of sums up the one-day investment training seminar. And of course, this online course, which we've now done in conjunction or in collaboration with the LIA, is is breaking it down into different modules and putting it online so that you can do it in your own time. Some key insights. Why do stock markets rise over time? They do. You've got to be in democracy, and you've got to have a government that's pro-business. If you don't have those basics, you've got no right to believe that the stock market can make progress. And indeed, you'll find in countries that aren't democratic and aren't pro-business, that property markets don't progress either. And really, it's business first. And then it's property second, because if we don't trade with each other, we're not going to have commercial premises or any need for them. These are very basic things, but they're important to understand. In terms of communicating risk, you've got to understand the critical difference between a regular investor and a lump sum investor. A regular investor is somebody who's investing over time, not necessarily at one go. A lump sum investor is somebody who has a lump sum today, and the amount they can contribute to that is modest in comparison to the lump sum. So they're two completely different risk profiles, and it's very important to distinguish between the two. And how do you define the long term? Because the long term is very different depending whether you're a regular investor or a lump sum investor. And, to understand why those trading markets or speculating markets cannot, in aggregate, hope to get the returns on offer. Because at the end of the day, the stock market in the short term is a zero-sum game. Some win, some lose, but there's no wealth created in the short term. Like property, wealth in the stock market is created over time. And therefore, you've got to own the asset if you want the returns from it. If you try and trade the asset, your risk profile increases exponentially. And again, it's important to understand that. And of course, why I'm bringing out these key insights is because these key insights are central to how you teach and what comes across in the course. Risks need to be defined. You've got the big 4 economic risks: inflation, deflation, recession, and of course, prosperity. And then you've got the individual asset risks, whether that's risks in individual equities or individual government bonds or inflation-linked bonds or whatever. You've got growth investing versus multi-asset investing, and what those two disciplines are actually all about. just to demystify it, I mean, there's as much property available in the stock markets as you could possibly want, through individual property companies or property funds or property exchange traded funds or indeed property investment trusts, all sorts of different fund structures. So property in our view is not a separate asset class. Many say it is, but we would not agree with that. Property is just a subsector of the overall economy, and therefore the economy is fully fully expressed in the stock market. Or the stock market reflects the economy, whether that's the technology side of the economy, the property side, the healthcare side, or whatever sectors are in the economy. They're all reflected in the stock market one way or the other. Understanding stock market volatility is incredibly important because volatility plays on our emotions, and it is emotions that are the enemy of sound investing. And even advisors are human, and we all get unnerved by volatility just as well as the client. But because we're supposed to be the professionals, we should at least understand volatility and be a little bit more calm. I would claim myself that our role as an intermediary, and Gillen Markets is an intermediary, is that clients are their worst enemies, and they will buy high and sell low if you let them. And our chief job is one of a goalkeeper, is to stop them buying high and selling low, and have a proper plan that they can rely on to get the benefits of the higher returns that the stock markets generally deliver over time. So you've got to understand what volatility is and why it's not actually risk. I don't explain that here today, but through the course you get a very good understanding of why stock market volatility is not actually risk. Even though if you have done the capital asset pricing model, you will understand that the formula for valuing an asset uses volatility in the stock market as part of that formula, and of course that can't be right. And then, of course, you have to not just understand volatility, but your plan and your client's plan has to be able to cope with that volatility, because it'll never go away. It's the nature of the market. And then understanding, what is the equity risk premium? And if I always like to turn that sentence around and say, look, it's simply the premium return you expect to get and have got over history for taking the extra risk that is associated with risk assets. However, time in markets also lowers the risk of a poor outcome, as long as you're diversified. So, we all know that, and have probably been thought that, taking a 5 to 10 year view is incredibly important, but you have to have the statistics to back that up to be very confident of that. And of course, that's part of what the course actually goes into. There are only, in our view in Gillen Markets, and in my view, there are only 5 major asset classes. It is equities. Equities is just business, and business does incorporate property. So equities and property to me are the same thing. The second big asset class is fixed income government bonds, because they are totally uncorrelated to equities, as are inflation-linked bonds, and inflation-linked bonds do something very different than fixed income government bonds. And of course, bank deposits are again different than the first 3. And last is gold, or precious metals, which are again cover a risk that none of the first 4 cover. And so, equities are really for prosperity, and the other 4 asset classes there cover one economic risk or the other, or a political risk, or whatever. So they're basically, those last 4 assets are covering a risk that the investor decides they want covered. And if you can't predict risk, what you do is you own the asset that actually covers that risk. In the last 20 years, the people in the industry are, and it's people believe that hedge and absolute return strategies and funds that adopt those strategies are a separate asset class. Well, we would completely disagree with that. That they're nothing more than actually trading around the 5 asset classes. And of course, trading assets brings in all of it, its own risk. So again, you have to try and understand that, or should I say, it's good to understand that. And again, it has to be backed up with statistics and facts. And we do try and do that on the seminar, or on the course. So what is the course supposed to do for you? Well, it's supposed to improve your understanding of the core principles of sound investing. I'm often criticized for that being a very boring line. But when you're in the professional area or arena, you're not there to provide the sizzle. You're there to provide the steak. The famous line, the sizzle on the steak. There's absolutely no point in listening to sizzle or listening to people who just come up with sizzle and good strap lines. And even though it's a boring line, it's still a sound line. You should be able to better communicate these principles to clients if you're in the industry after having done a course like this. And, you should be able to improve your ability to question fund managers about what they're actually doing, what their strategy is. It should encourage you to set your own financial goals, just on a personal basis, and to achieve financial freedom, because everyone can do that if you start out at a young enough age. That's why I'd be a massive advocate of ensuring that young people who, in their first job, that they should it should almost be compulsory to start a pension savings, because it's so advantageous to start it at that age if you understand enough about it. So that's really it, and I'll hand it back to Eva just to see if there's any questions, Eva.
Thanks, Rory. And actually, there is actually a good few questions in just around the course content itself and the modules. I wonder would it maybe worth, we might just go back to even just the module slide for a few minutes. And not to put you on the spot, Rory, but would you be even able to give, like, I suppose, like a high level summary of maybe what will be covered in each of the modules?
Yeah, well, look, let's take the second module there, right? Well, we'll take the first, right? Compounding. Very few people understand the power of compounding. And what you really have to get there is concrete examples of the power of compounding. And, and we go into that with a few examples on the day or in the course. And, it really is there to confirm to you that not just is a 3 to 5 year view, right? It's more than that. It's 5 to 10. And really, if you look at somebody like Warren Buffett, Warren Buffett's company, I think in 1990, say, and he was already at the helm of Berkshire Hathaway for 25 years, was worth about 4 billion or 5 billion in 1990. It's now 800 billion. So the second 30 years that he did in terms of compounding was just exponential compared to what he did in the first. It's not that the returns he was delivering in the first 30 years were any less than the second. In fact, they were better. It's just that to get off the ground floor, you've got to start somewhere. So it's very, very important to understand the benefits of a modest savings program that particularly young people can start and say that it's too small to start with. That's not the case. And so financial planning and compounding is a critical side of understanding what saving and investing is all about, but also being able to communicate that to clients if you are in the advisory side of the business. And it's really putting the practical examples around that and how you communicate that, as opposed to just talking about it, is what that module is all about. The module 2 is just, why do the stock markets produce better returns? You have to understand and be shown that companies generate a higher return on the capital that's invested in them than you can get from bank deposits. And you have to see that practically done, and you'll see that through the course. If that was not the case, then why would anyone take risk of investing in a business? Why would a businessman start his own business if he couldn't get a better return than he could get from bank deposits? And if you couldn't get a better return from investing in your own business because there is risk, then you simply put your money in bank deposit. And if everyone did that, clearly economics ABC would suggest to you that too much savings and not enough investment opportunities, interest rates would be zero, so we'd get nowhere. So the very basics of investing in risk assets is that we trade with each other. There is risk, but that risk pays off, and it always has done in a democratic society. And module 3 is about, look, how do you define the risks and how do you gain exposure to the market? In Ireland, across the life and pension broking industry, it's predominantly the life company products, which is absolutely no problem with. There's a good choice there. But outside that, for retail investors and others, there is the stock market system. There is the exchange traded funds. There is investment trusts. These are all fund structures that exist on the stock market, as well as individual companies. So the choices that you have in terms of gaining exposure to the market and the different tax regimes around them in Ireland are explored in that in that module. I don't want to go too much detail other than that, even in case I lose
Yeah.
everybody. Do you feel
Yeah.
that enough?
Yeah, I think so. And obviously, if anyone does have any specific questions, do pop them into the Q&A box for Rory. There is, a couple of questions on the duration of the course. So I think as Rory kind of touched on, there's 8 modules in total in this course, and they're roughly between 20 and 30 minutes per module. So not very long. And then there is obviously a quiz at the end as well. I suppose another question that's come in, Rory, is like, someone they don't have a background in investing, but they're interested in it. Would you recommend this course for them?
100%, because you've got to start somewhere. And what you really need is the framework of, why the stock markets and property investing works and what actually is risk. Once you get that framework, it's not important that you pick up everything off the course. It's important that you know what are the next steps to take. Whether
Great.
to pursue a role in the industry or whether it's just to start yourself in terms of a sound saving and investment program. I think the basics and the framework of what is correct and what isn't correct. Because many people think that they go on social media and read some articles and read up about Bitcoin and see people speculating and see people making money overnight and think that's the actual way to do it. And of course, they're a million miles from the truth. The truth is much more simple and much easier to follow. And albeit that it's a little bit less exciting, but that's the way it is. There's no excitement in investing. Some people, are gravitate toward and very interested in investing, and it would be a hobby for me, but others won't. And it's just it can be a career, or it can be just an interest in terms of saving and investing so that you can achieve financial freedom. But you've got to start somewhere, and to have it explained in a way where the bits of the overall jigsaw are put into place for you, I think is the best way to start. And I think that testimonial I gave you from that gentleman in Kildare who runs his own business is as good as I could ever get. And in terms of somebody endorsing the course in his own way.
Great. Thanks, Rory. And like that, like I suppose we've people that are on this call as well that might hold QFA or they might have APA investments. Similarly, I'm assuming then it's for them, it'll help with their client conversations as well, like this course.
Yeah, I mean, and if you see charts that I deliver, and I use a lot of charts, I use a lot of tables because I like using facts. And over the years, I mean, I've been doing the 1 day stock market training course since
Mm,
2005. And, I've learned over the years how to communicate what can be complex issues if you try and make them complex. I've learned how to communicate them in very simple ways. And I think one of the attributes of experience is that you can actually do that. And I enjoy doing that. And therefore, I feel I can say to people that they will be able to follow the course very easily. I'm not saying you're going to be an expert at the end of it. That's not possible. I mean, there's university courses and it takes a couple of years or whatever if you want to be an expert in valuing a company and things like that. But to be a sound advisor and to be a sound investor, you just need to know the basics. And Warren Buffett himself has always said that there's only a few things you need to know, but you need to know them well in terms of trust them and then just stick to those rules.
Great. Thanks, Rory. A couple of questions in about the kind of duration of the course and just the kind of logistics. So one person is asking, after completing a module, can you revisit the same module? Yes, you can. Once I suppose you actually complete the course, the content will be available for 2 months after that if you would like to kind of go back or download any of the slides or kind of look back on the recording. Um, Another question in is what time are the modules done? Like over what period of time are the modules done? So as I mentioned, the course it's available on demand, so you can go in and complete the course in your own time. We do recommend that you complete the course within a 3 month period because otherwise, if you kind of go past that, you're kind of forgetting content that you might have learned earlier on in previous modules. But you can go into a module, you can complete it. You can also go back if you want to revise a module that you might have done. You can move on to the next module. You can start a module, maybe just you might only get a chance to do half of it. You could come back to it and finish it out then, that day or another day as well. So it's quite flexible that way. Someone's asking the cost of the course. So it's €300 for LIA members and €350 for non-LIA members. This is probably one for you, Rory. If you're a lump sum investor, but you haven't made up your mind about investing the lump sum, would you recommend this course to help them understand and possibly guide them in making the right decision?
Yeah, 100%, because you have to understand your choices, and you have to understand the different ways you can invest in the stock market. Whether it's life company funds, whether it's stock market listed funds, or whether direct equities are for you. You have to understand the concept that taking a 5 to 10 year view is important. You've got to see the statistics behind that to prove that point. And you have to understand that the lump sum investor faces higher risks of mistiming their entry into certain asset classes, and make your choices accordingly.
Great. Thanks, Rory. And then this is probably another one. Um, could you define a regular investor and a lump sum investor?
Yeah, sure. The regular investor is somebody who doesn't have a lump sum to start with. So they're starting off with very modest beginnings, and they build their capital base or their savings base over time. And therefore, they're not really at risk of mistiming their entry into stock markets, or whatever asset class they're interested in. Obviously, for the regular investor, the risks are lower. Therefore, it should be equities the whole way, because there's the better returns. The lump sum investor faces a completely different scenario, and different risks, because they don't get a second shot at it. And the lump sum investor is defined as somebody who has a lump sum today, whether it's an inheritance, or whether they sold a business, or whether they were, whether they have sold a house or something like that. And, what they can add to that lump sum thereafter is not meaningful. Then I would class them as a lump sum investor. And it is important that they understand, whether the markets that they're about to invest in offer reasonable value or not. And it's an important part of the equation, because we all know that, back in the 2002 to 2007 period, investing in Irish property with a lump sum and debt, achieved nothing but risk. It wasn't going to achieve a return, because the asset was simply overpriced, and very overpriced. And that can happen in the stock market too. And, it is your responsibility to at least have a view on that, or to find out um, if somebody else has a view on that. And that's kind of in the background. Then, our training was always led people on to whether they wanted to be a do-it-yourself investor. And therefore, we developed the newsletter, which is Ireland's only newsletter, to provide that extra facility. That that that's how I tried to square the circle for people who wanted to be do-it-yourself investors. But I did soon learn in Ireland that the market for do-it-yourself investors was a very tiny one, and therefore we ended up becoming an intermediary ourselves, because most people just wanted us to manage the money, if you know what I mean. Sorry,
Great.
I've waffled a bit there.
No, no, thanks, thanks, Rory. And then someone asking, do they get CPD for completing the course? And yes, there's 3 hours CPD available for the course. Another question, I suppose, is, how does the course compare to the SIA, which is our Specialist Investment Advisor course? I suppose, like, it's hard to compare the two. They're two very different courses. Our Specialist Investment Advisor course it's a level 9 academic qualification. It's lecture based. It's delivered over 12 weeks, and it goes into an in-depth kind of a range of investment topics. So it would, I suppose, and it also has entry requirements as well into it, because it is a level 9 program, while this course has been specifically developed as like a short course available on demand, giving you the kind of practical tools of investing in the market and stocks. And there's no entry requirements as well for this course. It is open to everyone as well.
Probably different price points as well, Eva.
Very different price points, yeah, and I suppose like the while this course is, as I mentioned, is €300 for LIA members. The SIA course is €1,100. It's also one of the modules as well on our postgraduate diploma in financial planning program, which is the gateway to the CFP qualification. So it's often a route that people take if they're looking, I suppose, to become a certified financial planner. Um, just see now if there's any more, and then I know we might have to just kind of finish up, and I'll just maybe just mention as well about how people can register as well before we do. So another question in here is, are there similarities between stock market and property investing?
Yeah, because there's the basics of why both go up are the same over time. And in the stock market, it would be corporate earnings as the main driver of the stock markets, and it's looking at long-term statistics will tell you what the average rate of growth in corporate earnings is. Over in the property market, it is the growth in rental income that is the primary driver of commercial property and residential property prices over time. Well, maybe I should stick to commercial property. At times, the other factors take over in terms of stock market, and other factors take over in terms of property. But the fundamental drivers are important to understand, because then you can understand when something deviates from the long-term trend, and you begin to understand that. So they're pretty much the same. Now, if you look at rental income, you'll realize that rental income can only grow if corporate earnings are growing. So it's business first and it's property second. So it's important to understand the very basics. We wouldn't have, if people don't trade with each other, and people have traded with each other for as long as humanity's existed, that's where business comes from, and that's where the returns come from by doing that.
Great. Thanks, Rory. I think that kind of covers all of the questions. I might just get you, Rory, just to move to the last slide, just to let people know how they can register. So as I mentioned, registration is open now at the moment. So you can register. There is no, I suppose, cutoff period as such, as the course is available on demand. You can register through our website, www.lia.ie. Or alternatively, if you have any questions or about registering, you can also contact the education team at education@lia.ie. You don't have to be an LIA member, as I mentioned, to actually complete this course. You will have to create an LIA profile, which you can do free of charge, if you are interested in completing the course and you're not an LIA member. So just to mention, we will be sending an email after this webinar just with a copy of the recording, and just providing you with a little bit more information as well. If you do have any additional questions for myself or for Rory, please submit them, and we're more than happy to answer any questions that you might have. So I think that brings us to the end. Just to say thank you so much, Rory, for joining us. As I said, look, we're really excited about this course, and there's a huge amount of interest for it so far, and we're really kind of looking forward now to getting feedback as well from people who start the course. And also thank you to everyone who joined us this morning as well. And I hope you have a lovely day. Thank you.
Thanks, Eva.